Greetings everyone and welcome to our simplified stock investment course. So as you all know, stock investment is a very broad subject and we cannot talk about it in one sitting, but I'm going to try and summarize everything you need to know about stock investment. So we are going to briefly talk about everything involved. For those who want a detailed understanding, we are going to talk about it in subsequent videos. So first and foremost, what is a stock? You cannot invest in what you don't know. So what is a stock? A stock is a piece of a company. Excuse me. There are two ways in you can own a business. You can either start a business or you buy a business. So stock investment involves buying a business. You find a business that you think is good for you, and if you have the money and whoever owns the business is willing to sell, you buy the business. So that's the first thing you need to know. And there are two types of stocks. There are common stocks and preferred stock. So a common stock, let me start by a preferred stock. It's a crossbreed of a stock and a loan, whereby you invest your money in a business and you are given a constant dividend. Your returns are more or less constant. But as for common stock, your returns, the amount of profit you get from the business will depend on how the business does. So when the business is bad or making losses, you can not be given a dividend. When the business does extremely well, you are given a large dividend and so forth. So that's the main difference, but we are going to talk about it, as I said, in subsequent videos. Next up, we have stock investment strategies. So we have two main strategies used when you just don't you just don't start an account and start buying stocks anyhow. You have to know what you're doing. So there are two main strategies we use: value investment and growth in investment. It's up to you to determine which one of them is good for you, or if you want to do a bit of both. But value investment refers to you look for a share that is underpriced. Let's say, for example, you find a company, Facebook for example, and you believe Facebook is worth 10 million, but you go on the market and you find that Facebook is selling for 7 million. So in that way, you believe Facebook is undervalued. Let's say it's selling for a value less than what it should be selling, so you buy shares in Facebook. Then the next strategy is growth investment. Growth investment is where you buy companies that you think are going to grow in the near future. For example, you have a company that is making a profit of 100 million now, but you believe you have an ability to predict into the future, and you believe the amount of profit is going to increase drastically drastically, and in so doing the price will also increase. For example, you buy a 1,000,000 shares, each worth $10. So in total you invest 10 million in a business. Then after a year, each of the shares is worth $15. So if you sell the million shares, you get 15 million. So you've made 5 million in a year. So that's what growth investment is all about. And simply put, value investment is in most cases a it's a long-term strategy. Then growth investment is a short-term, but we are going to talk about them, as I said, in subsequent videos. So next up, let's see, we have we continue defining terms. So we have three financial statements that are used to record everything that happens in a business. So we have a balance sheet, an income statement, and a cash flow statement. So we are going to define both of them. So let me start with number two. Let me start from above so that you don't get confused. A balance sheet. So a balance sheet, let me just define it before I explain. A balance sheet contains assets, liabilities, and equity that a business has at a particular time. So an asset is something that brings value to a business. For example, if a business has apartments and through those apartments, the business gets rent every month. So those apartments are described as assets. If, for example, you have a computer and you use that computer to make money, that computer is your asset. So you record that in a balance sheet. If you have, let me see, if you buy stocks in future, and these stocks give you money through dividends every year, those stocks are defined as assets. Next up, we have liabilities. A liability is something that brings value out of the business. For example, you are owed money. You need to take money from the business to repay that loan. For example, a mortgage. You take a loan and purchase a house. Later on, you need to take money from the business to pay that loan. So the loan becomes a liability. Then equity is the difference between assets and liabilities. For example, if you have assets worth $100 and you have liabilities worth $50, so the difference, which is $50, is your equity. If you have a business that is about to go bankrupt, the business is not making profit, it needs to be sold. So you sell all your assets. If you have land, you sell the land. If you have a building, you sell the buildings, whatever. And maybe let's say you come up with 80,000. You've sold all your assets. Then you repay all your loans and all the salaries and all your suppliers, and maybe all that totals up to 20,000. So you are left with, the difference is 60,000. So that's the money that's the money that belongs to you after you liquidate. So that money is known as an equity. So the difference between assets and liabilities. Next up, book value. Book value equals to equity per share. Simply put, for example, let's say a business has land that is worth, let's say a business only invests in land. So the business has assets worth 10 million. And if you purchase one share, part of that land that belongs to you is worth 4 shillings. Let's just say the share is bought for a price of $15, but the amount of land that you get is $4. So that's $4 we can refer to as book value. Next up is the income statement. So the income statement shows the revenues, costs, and profit. For example, if a business deals with importing clothes, let's say it imports clothes worth $70,000 and it sells them for $200,000. So the difference, the profit made, is 130. So the place where the cost is recorded, the 70,000 that was used to import the business, the place where the total amount sold, 200,000, is recorded. In addition to that, the profit of 130 is recorded, is known as an income statement. And profit per share is known as an EPS, or an earning per share. No, we don't call it profit per share because we don't want to complicate things. So for the whole business, it's known as profit, but when you narrow down to a share, it's known as an earning per share. The same way, for a whole business, we call that equity. We call all the properties, all the equity that a business owns is known as the equity, but when you narrow down to a share, it's known as the book value. So next up, we talk about the cash flow statement. And basically, the cash flow statement, as the name suggests, it shows you how the money moves inside the business. So it has 3 sections: the operating activities, investment activities, and the financing activities. So operating activities shows you the activities that are the main activities that bring money to the business. For example, if you invest in a company that mainly owns restaurants, So operating activities, when you come to operating activities, you will see how much money has been invested into the restaurants and how much money is coming out, how much money is being used to pay rent, how much money customers are paying in total, and so forth. So operating activities, that's where you find such. Then investment activities. There are two types of investment. A business can either invest inside the business or outside the business. Let's say, for example, you go to the stock investment, you can find that a company has bought shares. So that's an investment activity, but outside the business. Then a business can invest in itself. For example, buy new computers, buy new chairs, buy new tables. So this is where it's recorded. And lastly, there is financing activities. Money comes inside the business, maybe a loan, or whoever owns the business wants to inject more money inside the business. Maybe money goes outside the business to repay a loan, or it's paid as dividends to whoever owns the business. So that's why it's recorded. Next up, we're going to talk about the stock market. So a stock market is simply a market where shares are bought and sold. For example, if you want to purchase any shares of Facebook, you go to the stock market, you put in a request, and if there's somebody who wants to sell, you get to buy. Then you say stock prices are determined by forces of supply and demand. I know most of you have seen how the stock market operates. Today a stock is worth 10 shillings, tomorrow it's worth 12 shillings, for example, or today it's worth $17, tomorrow it's worth 16. So the price fluctuates. If I have shares, for example, and I want to sell them for $17, there's somebody somewhere who wants to sell the same shares for $18. So the prices are determined by forces of supply and demand. We are going to talk in detail about that later. So next, dividends. Let's talk about dividends. So a dividend is a share of profit issued out to shareholders. For example, I buy shares of Google, for example, and at the end of the year, Google makes a profit of 200 million. And they decide that out of this 200 million, we are going to pay 80 million to shareholders. So we are going to pay each shareholders depending on how many shares they hold, but the total amount we are going to pay is 80 million. Then the remaining 130 million remains and is used to grow the business. So that part that is paid to shareholders is known as dividends. Okay, so the only way you can buy shares is through brokers or electronic trading platforms. You don't directly go to the stock exchange and say, here I have money and I want to buy stocks or shares. You go to a broker. Many brokers have electronic trading platforms, so you put whatever. You say, I want to buy this type of shares, how many type of shares, and if the shares are available, you get to buy them. Then another statement I've written down there, you can either invest in shares directly or indirectly. So for example, Facebook has shares. I can either directly purchase the shares of Facebook. Then there is another way where I can buy shares in a mutual fund or a company. This is just a company that specializes in buying shares. So I can either buy the shares of Facebook directly or buy shares in a mutual fund that will in turn buy shares in Facebook. So you can either invest directly or indirectly. We are going to talk about the advantages and disadvantages of both. For people that are knowledgeable, it's advisable to buy shares directly, because that way you get to receive, the amount of money you get to receive there is a huge amount, so there is a huge risk, but there's also a huge return. For those that know how to navigate the stock market, buying shares directly is recommended, but those that are new or those that don't want to be directly involved in managing, they want somebody else to manage the shares for them, you can buy your shares indirectly. Then other things that are available in the stock market, other assets that are sold in the stock market, you can buy stocks in the stock market, but apart from that, you can also buy a REIT. REITs refers to real estate investment trusts. So they are companies that invest in real estate. So you can buy shares in a REIT. Then next you have treasury bonds and bills. You can loan money to the government or a company. Instead of buying part of a company, you decide to loan money to the government. Then next, another asset that's available is a future or a derivative. So simply explained, a future it's a contract. Going by the name future, it's a contract. For example, let me just use an example. For example, you have shoes that you want to sell, and I'm interested in the shoes, but I don't have money at the moment. So we can enter into the contract that says 3 months from now you will sell me the shoes at this price. So we come up with the contract and we sign it, and after 3 months I come and I buy the shoes at the said price. So that's a future derivative. So how does it help in the stock market? For example, you want to buy stocks, so you enter into a future contract with a person who holds the shares of the stock. So we say, a year from now you will sell me these stocks at this price, regardless of whether the market price of the stocks at that time will be higher or lower. So that's a future or a derivative. We are going to talk about it in detail later. Next on, we talk about how to identify good stocks to buy. So how do you identify a good stock to buy? I always say rule number one, buy a stock with long-term prospects. Don't buy stock in a company that will not be needed in 2-3 years or maybe 10 years. For example, I'm going to give you an example. For example, you feel like plastics won't be needed in the next 5 years. So if that's the case, don't invest in a company that manufactures plastic. Next up, I say buy a stock that is stable and predictable. Don't buy a stock that is selling for 7 shillings today and tomorrow it's selling for 20 shillings, or today it's available for $3, tomorrow it's selling for $25, the next day it drops down to $1. So that's stable and unpredictable. And another way, you look at a stock that this year the stock has made a profit of, let's say, the company has made a profit of, let's say, 50 million, and the next year they make a loss of 20 million. The next year it's a profit, after that it's a loss. So that company it's not stable and not predictable. Buy a company that has a good track record. For example, a company that has made profit in the last 5 years continuous, or the last 10 years continuous. Maybe they've only had one loss. That's understandable, but buy a stock that is stable and predictable. Next up, buy a stock that's under good management. We're going to talk about how to identify good management later, but basically you look at how the management manages debt. A company that has a large debt is under bad management. Next, buy a stock that is undervalued. Buy a stock that is selling for a price below its true value. For example, if you believe a stock is worth 20 shillings or $20, only buy a stock when the market price is less than the 20. We are going to talk about how to value a company later in subsequent videos, but for now, just internalize that. Next, buy a dividend paying stock. Buy, there are two types of companies. There are companies that make profit and reinvest all the profit back into the company, and there are companies that they earn money, they pay you a portion of it, and they invest a portion back to the business. So I always prefer companies that will give you a portion so that you can invest somewhere else while at the same time retaining your stocks. So that's all. We are going to continue talking about stock investment in subsequent videos. Thank you for watching. Leave a like to help the channel out, and subscribe, turn on the notification button to receive our subsequent videos. Thank you. God bless you.